Good morning, traders. Welcome to the Flow Show. Here we are, Tuesday, 1st of August. Pinch punch, first of the month, guys. No returns. How you doing?
Pinch punch, first of I've never heard that. What is that?
Never heard that one. I do it with the kids. Every month they usually get me because I'm never awake enough. They jump out of bed, they run into me and give me the old pinch and a punch on first of the month.
I got you.
But I got them back today because they're on this scout camp. I text the scout leader and said, tell him to give them a pinch and a punch from me. So
like a proper punch.
What? Yeah, I've got to go to the hospital later, pick them up.
Good morning, everybody.
Managed to get them back. Morning, Kay. How you doing?
Hey, morning, guys. Hey, must still don't worry. Something probably must be a Bournemouth thing or so. I mean, I never knew about that either.
No one's ever done pinch punch first of the month. No returns, or it must be a UK thing.
Yeah,
it's been going on for ages. Well, you can introduce it now to your kids and family.
I wouldn't dare anymore. They're stronger, much stronger than me.
Yeah, that's the other thing. You only get so far before they get too big and can kick your ass.
Exactly.
Anyway, I don't want to go for my kids, but we'll end up that way, no doubt. Right, let's get stuck into things. China State Planner is going to extend loan support tools for small and micro firms until the end of 2024. More tinkering around from those guys regarding what they're doing, trying to kickstart bits and pieces in the economy. A ton of data out, as we've mentioned this week, more data this week. Final PMIs dropping, so that's where we're going to start if I can find them. We have Japan. Ooh, where are we going? There we go. Japan manufacturing PMI 49.6, a little bit of an improvement there over the 49.4 previously. Still, we're in contraction, but at least it's heading the right way. China as well, manufacturing sinking into contraction. Was expected to fall a little bit. This number's been up and down, in and out of expansion and contraction of late, but following what we've seen elsewhere. Over in Japan, they spent the princely sum of 0 on currency intervention last month, according to the MOF, the latest MOF Ministry of Finance report. They always report how much intervention, if any, they do. And there were a few people who were touting that there might have been some stealth intervention when we were up around 145. I didn't really believe that. And thus it's proved to be the case that they've done absolutely 0 in that front. Economic Minister in Japan said the bank's Friday decision was meant to increase sustainability of monetary easing by making YCC more flexible. And we should not think that the Friday decision as a shift in monetary easing stance. Well, anyone who's looked at a dollar-yen chart since Friday will know that not too many people have seen it as a shift in the BOJ's monetary easing stance. And we're back on the FX watch again. Finance Minister said FX should move stably, reflecting fundamentals, and to closely monitor FX market moves, which have seen changes in environment. So we're back on that bandwagon again. It's going to be a bit like deja vu when we were running up to 145 last time. If we start getting up there fairly swiftly, we're going to be playing the same old game of when do they increase their steps in rhetoric in terms of what the currency is doing. For now, it's moving okay-ish. We're not quite as volatile as we were in that run, but you know, we have done quite a lot since the BOJ 138 pretty much to 142.80. So done a few pips, so we just need to keep an eye on if the volatility does continue there. Over in Australia, data coming out there as well. Building approvals not looking too hot, worse than expected on the month, worse than last month, pretty much double the drop to 18% there. but on the month, minus 7.7, 0.7% worse than expected. Home loans are taking a bit of a drop as well. And as you can see, just some of the other numbers not coming in overly hot as well. Then we got their PMIs as well, coming in at 49.6, the final number there, which was unchanged over the flash reading, and a bit higher than last month, but still in contraction. And we've got the RBA decision where they remained unchanged. Now, probabilities were siding with an unchanged report, but then the balance of analysts at the banks, that the Wires poll, were looking for a 25 pip hike. So that was a bit of a surprise to the market that they stayed unchanged. They repeated their same line from the last meeting, that some further tightening of monetary policy may be required. They say the Australian economy is experiencing a period of below trend growth, and this is expected to continue for a while. Overall, I know you were up for it, Kay. Overall, sounds like maybe they're more at a top than on a pause.
Yeah, it does look like a bit like ECB, well, maybe a little less ECB, but like the Fed as well. They may be, if forced, another 25 in there, but yeah, they look to be close to done. One thing though is that it's the one before last meeting of Lowe, so it's not Sandra, but Michelle Bullock will take over from after the next meeting. So he may be letting her do some of the work if needed later towards the end of the year. But yeah, it does look that RBA doesn't want to kill the chicken laying the golden eggs or so, and or doesn't want to risk too much of the economy, and they are clearly erring on the cautious side because the prior numbers, labor report and also inflation remaining sticky, could have warranted another hike, but they decided against it, and yeah, Aussie took a bit of a slap. I also think it's still the aftermath of the month-end flows, which were clearly to the other side, which have accelerated this move a little bit. So yeah, but Aussie looking at that week this morning, and rightfully so, I'd say.
Yep, exactly, and no let up there. I have been keeping half an eye on Aussie yen because I thought that might be a bit of a counter trade to look at if it was bearish or dovish from the RBA, and yen pairs keep ramping high, but it's a little bit mixed at the moment. We're seeing Aussie yen down, Euro yen's not looking as strong, GUP is looking strong, so there's a little bit of a washing machine going on at the moment. Euro dollar's down, cable's not falling as much, putting a bit of pressure on. So I'm not overly keen on maybe trying to catch a knife in the Aussie yen just yet, as I spoke about yesterday, but it's one I'm going to keep half an eye on. Anyway, back to the data and coming into the rest of Europe, and it's been a real mixed bag. Manufacturing still looking a bit iffy. Spain there, as you can see, further into contraction. Italy, a little bit of an improvement, but small pluses amongst a big negative. All these numbers still well in contraction. France as well, a little bit of a tick up, 6 pips on their number there. Germany still well in the doldrums, 38.8. Unemployment though looking okayish, a drop. The change was down 4k in unemployment. Unemployment rate ticking down a bit to 5.6%. Italy as well, showing that the jobs market is ticking along. A drop to 7.4% from 7.5% previously, was expected to rise to 7.7%, so catching a few on the hop. And look at good old Greece, 53.5. What's that? That's July numbers, so that must be all the surfboards they're producing for Stelios to buy.
You know what? All jokes aside, we are very lucky that we had the election results recently, and it's the same government for the second term, and there's a lot of stability. And I know Greece is only a small country, but we've seen what happens when even a small country of the Eurozone gets in trouble. So this is good to have stability in this country, because I tell you, I know this country, it's not going to last for long. So,
Yeah.
you know, at least for another 4 years, we are okay, because this government is absolutely fantastic in terms of investment, in terms of running things smoothly. So fingers crossed.
Yep, indeed, mate. As someone who knows exactly what a stable government can do to shoot itself in the foot, considering what we've gone through over the last few years, and the fall from grace of the leading Conservative Party, yeah, if you get stability, grab onto it with both hands. Eurozone manufacturing PMI also coming in, flash number coming in as per the last number, as well as per the flash number, I should say. UNOKI's a decent improvement there, big jump, 56.7 from 47.3, so moving massively into expansion there. Kay, did you see that? Any reason?
Well, you know what,
that?
It came out while I was off the desk, and I've seen it. And then if you look at the Norwegian kroner, it actually only had like a really, really temporary blip. Perhaps it's some summer thing or so. I really don't know, mate. But we've seen Brent and stuff prices go up again. Perhaps that's something to do with it, because they are a massive exporter of oil and gas, of course, and wood. So yeah, maybe just related to that. They've also enjoyed in the month of July the revival of the Norwegian kroner. So I'm not sure whether it's a forward-looking or a little bit of a back-looking data there. But yeah, it's surprisingly strong, and it's surprisingly unaffecting the Norwegian kroner. So
Yeah.
now Norwegian kroner should really have benefited from it, but as I said, I mean, it's just it was just a blip, not even like a big move. If you look at the 15 minutes or 5 minutes or whatever, it's not really done much.
Yeah, nothing at all really. So yeah, okay, well,
moving
on.
Which is in fact a bit surprising, because looking at this, there's less volatility in those currencies, so it should have actually moved quite a bit. But
yeah, I might have to go and dig up the report, just see if there's any out there in it, because it's not often you see big moves like that in the PMIs, particularly going against the grain. But anyway, I'll have a little dig, see if there's anything interesting in that. Coming over to the US, Fed's Goolsbee says it's fabulous news to see inflation coming down. We have to play by ear on restrictiveness of policy rate. Have not seen more tighter credit conditions than expected. He hasn't decided on a September move. Now, actually, I just want to go back to the German numbers, the PMI numbers, because one thing that stuck out from that in the report is that the commentator mentioned deflation. They said that the Germany sectors were in deflation. Deflation is here. That's a big word to pull out the hat, particularly in Germany. Now, that's one of the words. If inflation keeps falling back, if we start seeing some negative prints, that's going to be the key word, the buzzword that's going to come out on a lot of lips. We're all going to be hearing about, oh, it's the end of inflation now. We're going to be entering a deflationary spiral. Central banks will have to be careful, blah, 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 which, of course, will all feed into rate cut talk as well. Now, we haven't heard deflation too much, if at all, but a big reporting firm like Market bringing that up in a German report, and they're big on inflation, whether it moves both ways, could be a little bit of a signal of what we're going to be expecting over the months ahead, talking about the cut trade. So I just wanted to flag that up.
Yeah, right. I just hope it's an objective report, because I've seen who reported it, and that doesn't seem like a completely impartial person. It's not somebody from HCOB but it's somebody from a bank, right? And one of the
I'm not. I don't.
Yeah.
Do they use the bank people in it?
Well,
I know that it's sponsored
like
by
Hamburg Bank or something. the person who said it.
I can tell you who said it. Yes, you're quite right. He is the chief economist, Dr. Cyrus de la Rubia.
Yeah, very German name as well.
Yeah, chief economist at the Hamburg Commercial Bank, who sponsor these reports now, said, well, I can quote here because I've got it on the thing, deflation is here, at least in the area of goods, because input costs fell at the fastest rate since the global financial crisis, and the same was true for output prices. So anyway, as mentioned, it's just a bit of a language pop-up that may feature further on down the line, and we'll need to be aware of it because that's what's going to move rate expectations for that. Right, a couple of other pieces, just stories I picked up. In the US, apparently homeowners who report that their mortgage rates are below 5% are nearly twice as likely to want to hang on to their current home. This is another effect of rate hikes in the US. The way it works in the US, for those that don't know, is you get buy a house or whatever, and you get pretty much a 30-year deal. That's the standard, and that interest rate is locked in for the period of that loan. So if you move house and you have to remortgage, then you're going to be remortgaged onto a higher rate. Now, if you're paying sub 5% and rates are now 6-7%, you're going to be less inclined potentially to pay an extra 2% for the next 30 years. So what that can do is, as the story says, is keep people from moving home. What effect that has is on demand for housing. There has been a bit of a glut, a bit of a shortage in housing. We might see that sort of thing easing off a bit now. So keeping an eye on the inventory side of the house numbers could be important, because it could indicate a slowdown in the housing market, another after effect of higher rates. So anyway, just a headline that popped up that just need to keep an eye on if that plays out in the data coming up. Another story was, according to the FT, saying that there is a tremendous amount of uninvested cash sitting on the sidelines. Some big investment firms are not putting their cash to work with some of the big funds and some of the big brokers, which is causing a bit of angst for those guys, because they would rather leave their cash in accounts earning 5% than put it into riskier assets, even stock markets. Again, this is something that we've spoken about previously. What can happen when rates go up? What can happen with bonds? That the market, some investors will put their money into cash in a bank account where it can earn 5%, rather than try and risk it earning 5% in stocks. They will put it into bonds, which is a guaranteed return for very little risk because it's backed by governments. So, and okay, you were saying yesterday and previously about, the stock market rally is maybe some of that cash that was sitting on the sidelines coming to work in that, but it's still a bit of a muddy picture, isn't it?
Yeah, but I really think this article is the hedge funds and some others crying their mum because they don't see enough money coming in there. And all the money goes into money market funds. But the thing is, and we've spoken about that. There's technicals and stuff, but we've spoken about that already in length. There's a clear, and we've seen those reports, and we've seen those banks continuing to call and asset managers continuing to call for a recession, but they have to push back against it, and. So, I mean, some of the cash that went into money market funds, but other cash, you have your models, you have your investment strategies, and you can tweak them, but you can't completely change them. So, and I reckon there was a lot of underinvestment as well in the equity markets, and results are, again, I haven't looked at all the details, but most of the time when I saw results coming out in this round, they haven't been too bad either, right? I don't know if Stel has had a closer eye on the results coming out, but I think globally there's no big dramas again. So that is naturally underpinning a bit of investment in equities as well, I reckon.
Yeah, well, I wanted to ask Stel about that, because obviously you've worked in rates markets. You must have seen periods where people just wanted to park park in safety and park in yield rather than risk.
Yeah, absolutely. And I still remember when UK rates were at 5.75 before the crisis, and there was a lot of it was a similar story like we're seeing now. It's not, especially now after 15 years of zero rates, we're seeing 5% rates in bonds, and which is theoretically secure, and there's definitely a lot of money being poured into that, and I see it from people I speak to, everybody's saying we're never going to see, well, no, we're never, but this has been a long time coming. This is the time to get your 4 or 5% risk-free return. So there has been a lot of flow into that, and this reminds me of the situation just before the crisis in 2008. So yes, I think there is definitely still cash on the sidelines and basically not invested in equities. So I don't dare to think what's going to happen to equity indices once some of that cash gets transferred over to from bonds to equities. So I think this is, there will be eventually an asset reallocation, basically, out of bonds into equities, and I really don't think we've seen a lot of that yet, which is crazy.
Yeah. Do you think stock markets is still a case of the few holding up the many? The big stocks holding up everyone else?
It looks like it, and results have still been good. So you have the big 5, 6, 7 names doing very well. I haven't actually looked at the details recently, but I remember people weeks ago analyzing and saying, look, there's these 5, 6 big names, and 50% of the Nasdaq are red on the year or something like that. And so it is a K-shaped recovery for equities. So you have the big names which are doing very well, and the little names which are struggling. So but for now, I don't see a change in that trend. So I'm going to reiterate, I wouldn't go against this move, but you're absolutely right. I think there's a few names which are supporting the indices pretty much.
Yeah, which would suggest that if those started turning over, then the pullback is probably going to be more crash-like than just a subtle pullback.
And that they will turn lower at some point.
Yeah, absolutely, absolutely. Right, well, that's all I've got on the headline front, unless you guys have anything you want to bring to our attention.
Oh yeah, one thing is that the Treasury came out with their expected borrowing needs for the next quarter, and indeed, as I said, I think perhaps yesterday on F.A.C.E, the report confirms that they are going to issue some more bonds for people in our community. I've posted it on in the newsroom early this morning, where you can find the guide, the amounts they expect to need to borrow. So it's a bit more as the past quarter.
Yeah, thanks, mate.
And one more thing, Bran writes, if I was into bonds, I'd grab those yields. Absolutely right. And I don't have to go far. My brother, he has had some money to invest a couple of months ago, and he's like, I'm buying 2-year French bonds. You can get 3% or 3 and a bit percent. He didn't want to get into dollars because he doesn't trust the dollar going forward, and I'm with him. So he says, yeah, I'm going to grab my 3%, 3.5%, whatever it was, and I'm happy with that. And he might be, just for context, my brother's been investment banker for about 25 years, so he knows his stuff. And there's lots of people who are grabbing those yields, Bran.
It seems he didn't trust Greek bonds either.
Well, Greek bonds are yielding the same, almost the same. So I definitely don't trust Greek bonds, that's for sure. But, if France is 3% and Greece is, actually, Greece might be even lower than France. I don't know. But if it's the same level, it can't be lower, no.
That's a big mistake still, not to trust Greek bonds, because there's been the proof in 10, 11, that Greek bonds are the best to be in, because they're getting a bailout, whatever happens.
Yeah, well, we had a haircut, remember? That was very damaging for a lot of people.
I'd like to know the last time you had a haircut, mate.
2006.
There you go. Greek bonds, Greek 10 years, 3.8%, 2 years 3.52. So yeah, you could get a few percentage points better than you can in France if you want to wear 25 pips of risk between the two countries. I don't know. I think I'd trust Greece over France the way things are going at the moment. But, yeah. Anyway, moving back onto markets, but yeah, it's something for people to look at. You know, if you've got investments and stuff. If you've got financial advisors, you know, it's a way to look around and, you know, you can lock in some yield, take away the risk. But, you know, that's not my financial advice. That's just common sense, I think, in this day and age. Because there's a few people who won't know what it's like to have high rates around. You know, it's been good 15 years since we've had rates well high or well above or around where they've been now. So, yeah. A lot of getting used to. Anyway, back to pricing. Dollar yen still on the march. I've got a line up here, 142.85. It's a bit of just an old level, nothing too significant. One of those ones. It goes all the way back to this area here. You can't really see that clearly, but it's when you look at the shorter time frames and scroll back. Where I can't even know where it is. Back here, there was a bit of action in there on the way up in. This move to the 150s and had a bit of a move on the way down as well. So this 142.85, one of those lines that have just shown up again in the price action where we haven't been there for a while. But I'm not trusting it too much, but it's holding for now. 143 is probably more important going into that. We have been playing the big figure tennis, as you can see, they get into 143, bit of a support point, bit of a messy number around there. As you can see, that 142.80 also in the mix there. So getting up to 143, then 143, 40.50 is going to be another smaller level again. Just a bit of an on-off level when we went to 145, a bit of a level on the way down. Not that it lasted for too long, but if we get above there, then maybe we're on for a move towards the 145 again, and that will be my big area of interest. At the moment, this one just seems on another bit of a grind. It's you know, technically it's doing what it needs to do. We had the break up, 140, 190s, 142s. We had a bit of a mooch down. That's where it held, and it's sprung back up again. 144, 142, 24, 25. That area holding a support now. So technically, it's doing what it should be doing, also making a new high. Are we back in a mode, Kay, where it's just sell yen and shut your eyes and, you know, see where it goes, or do we need to be cautious up here?
I'd hope so, because I still have my 144 and 144.5 calls running in dollar yen, but okay, that's for the end of August. But I think it's rather going to be a grind from here, unless we see a change or a big enough surprise on those US data coming out. I think it's over to the US right now. I would say that the JGBs, as I said, I think the yields are very, very gradually. They are going to let it go, perhaps up to 1% or so. Well, 1% will be the cap, but I'm not sure at this rhythm that we are even going to get there, because I've already read that the Japanese investors are happy to jump already back into JGBs, and we are like a mere 10 BPs above the prior hard cap. I think it's going to be a grind, mate. And I am right. I'm just looking at those crosses, and I'd say for cash positions, it may be more interesting to do crosses than actually dollar yen. But of course, we have all those US data out, so those are probably going to make me lie. But I think the market itself, we saw the counter reaction after the Bank of Japan. We saw you with the comments. We saw these. The market was extremely positioned or expecting the Bank of Japan to move the yen market more. And we have seen this reversal, and then we have seen the Suzuki already out, which I said who I said yesterday may start to look at things, because we did this move from mid-range to 300 points up. So I guess my best guess is that dollar yen is going to be a grinder right now, but it is probably going to retest higher levels. I've got some in the 143s, which is then going to be the gateway to 145 again, right? But the vols are starting to come off, so I think it's probably going to go a bit slower. I wish we would be at 144.5 today, but I'm not sure we will be. So yeah, and that's what is going to make the crosses a bit more interesting. Stuff like you were telling about the Aussie yen. I don't know. If you look at again, the dollar mix, for instance, is relatively stable, and if you or if one would think that it's going to be a grind. For sure, carry trades are not dead yet, and I can imagine that people will hold them right now. Yeah, the mix yen and stuff. But I think dollar yen is going to get to slow down now. But yeah, for as long as nothing changes in the US, I'm looking at.
Yeah, thanks, mate. Mike, asking about cable. I'm getting the sense you have a strong bullish bias to cable, Mike, because your questions tend to float around, what will support cable, what will make it go up, what will not make it go down, sort of thing. So I'm getting your bullish bias coming through. Do I believe the UK US yield spread will be enough to give support to cable on a BOE disappointment on Thursday? It all depends on what the disappointment is. If you're talking rates, 5.25 getting to 5.5 puts them in the same ballpark as the Fed. On that basis, you're going to be seeing money flow, not on the rate divergence, but on which is going to give you the better return. Again, it's a risk trade. So on disappointment, are you going to see cable holding up? If the market's not too bearish on the UK and it remains fairly bullish on the US, then that's your support area versus the rest. For example, the euro, which is under a bit of a cost today versus the pounds. That shows you where the weight of that is. But, I don't see a reason why the pound would collapse any particular point in time. My view on the UK, it's always more bearish in the press than it is in real life. So yeah, look at that. But it's going to be down to the data. It's really going to be down to the data. So I think the main question for you, Mike, is not to ask. Take the other side of the trade, if you like. Don't ask what would support your bias. Ask what wouldn't support your bias. Because if you can answer those questions, if you can answer and account for what will go wrong with your trade, well, then everything else is on the plus side, isn't it? And I say this to a lot of traders because this is what I do. I don't look at what can go right with the trade. I'm only concerned with what can go wrong. Because if I can cover that side, the only other way it can go is right. So that's the way I look at things. So don't try and build your own bias and support your own bias. Be objective. Work out what can go wrong to your trade. What is it that could happen that will turn your trade into a loser? And if you can account for that, if you can plan for that, it won't be a shock if it's happened. You can manage your risk. You know what you're prepared to lose if you're wrong. But then the other side, if you've covered all your risk, then all you're looking at is reward. So always come from your trade from what can go wrong with it, not what can go right with it. Anyway, Stel, you got anything? Do you want to have a quick look at a couple of metals?
I can have a look at a few charts. Yeah,
yeah. We're gonna give you a couple, and I'll give Kay a couple.
When Stel is loading them up, Ryan, you have to.
Yep.
You're already talking about the second part of your trade, because the first part is to build your bias, and because that is where your starting view is, because you want to buy or to sell. So then you look at what can go wrong, right? You have to do
but I actually
on the
look
right
at that
side
before.
first.
Yeah, but I look at what can go wrong before I even put the trade in.
But you can't look at what can go wrong if you didn't make up your mind what kind of trade you want to have.
Oh yeah. It's almost like questioning myself. I think dollar yen going to go to 145. Yeah, and I've got this evidence to say it might do that. Well, then after I've got that evidence, I say, well, what evidence is there that might stop that happening? And then you just add it all together. And if your positives outweigh the negatives, then you maybe decide to take a trade. If you've got 3 positives and 10 negatives, you might be less inclined to take the trade in the first place. So yeah, it's just you've got to be objective in trading. That's the one of the biggest things. Don't marry your bias. Don't, I think, be objective. Question yourself. Question your theories. Question your strategies. And if you feel positive after you've done that, off you go and trade. Simple as. Anyway, over to you, Stelios.
Wise words. Well, I'm not going to say anything new, actually, because we haven't had anything. Sorry, I'm going to make that go away. We haven't had anything new. So, my views remain the same over the past few days. So, we're seeing a bit of a reversal today. Dollar was selling off yesterday. It's rallying today. I think we need to work off oversold conditions and short conditions basically in the dollar, and I think that's what we're doing now. We could very easily we're getting towards an area where there's going to be a lot of interest. Hold on. Oh, guys, give me 1 minute. My lunch is here. I'll be right back. Okay, hold that thought. I'll be right back. Take the screen.
Oh my God!
Sorry. It's always the case, right? When I've been waiting for 30 minutes. I'll be back in 1 minute. 1 minute.
Oh my God! What do we do, Ryan? Do we have like a beam or an aperitif while Stelios is going to grab his lunch?
I don't know. We should play some music, some lift music. We'll hum a tune or something.
Some light. But you know what? I'm going to give my 2 little pennies on what Mike says about the UK. I think that the sterling has been behaving very well up to now, and rightfully so, because the data have not been as bad or as going down as rapidly than elsewhere. But we know that the UK situation is always a bit fragile and can change quite quickly. But I've got the impression that there may be a little bit of an overshoot on sterling coming on the Bank of England. So that's my original thought, at least, and then I will test it to what's really happening, because sterling can rally further. But I've got the impression that there may be a little bit of a negative snapback on the sterling once we get the Bank of England out of the way. But that's my thought right now, and I don't have a position, and it's just a thought that I'm going into the Bank of England with, and then then I'll test it against what is really happening. That is my.
I'm back. Sorry about that.
Thought.
You should be sorry, mate. You guys, you Greek guys, 11 years ago, you were like Oliver Twist in the workhouse, going up with your bowl to the EU, saying, "Please, sir, can I have some more?" And now we have to sit here while you have lunch delivered to your house. I tell you how things have changed.
fresh fish as well, really lovely. Anyway,
even worse. I'm gonna ban you from this show, I think.
So I was saying the dollar, I think, and remember we were talking about this about a week ago, that the dollar could be ripe for a squeeze because of the short positioning. And I think this is what we're seeing. And yesterday, month-end flows probably were dollar bearish, and now we're seeing this reversing today. There is a big kind of area around, I think, peaking at around 103, 103.5. All these, 50 DMA, 200 DMA, this trend line resistance. I think we could easily get there. And if we do get towards 103, 103.5, I think that will mean that the position gets lightened up a little bit, and then we can resume lower. My core view is that we're going to see dollar and yields lower. And, the RBA not hiking is another piece of proof that central banks are really, I know it doesn't make too much sense, but they're following the Fed, aren't they? I mean, as soon as the Fed looks like they are pretty much done, everybody starts turning dovish. Even the ECB with inflation. Okay, inflation is dropping, but it's still at high levels. UK the same. So I think yields have topped. grab your yields while you can. That's my view, and I think the dollar has stopped as well. But we could easily see a little bit of a more of a squeeze. I'm looking at when we get towards these levels to short dollar pairs, definitely. So 10-year yields in the US, again, I think we're going to be topping around here. If the dollar squeezes a bit more, maybe we get towards these highs. We could even take them out and sucker in new longs in yields, so short in bonds. But I think we're heading lower, and we're going to be testing these lows at 330. I mean, I see no scenario, no probable scenario where yields are going higher. Of course, if inflation starts picking up globally, then it's a different story. But I think we're going to see subdued and dropping inflation, at least for the next, say, 6 to 9 months. So for that time frame, this is my view. A year or two from now, who the hell knows? I mean, I can't really say. And even if I say, it's just conjecture and I have no clue. So with that in mind, if the dollar and the yields are going to be dropping, okay, maybe a short-term spike, but I think they're going to be dropping. That means that risk should theoretically continue to grind. And barring any big misses from the big names in results, we continue going higher. I see no technical evidence at all that, or macro at the moment, that we're at a high in equities. And you know, the DAX hit new all-time highs. Okay, we'll come back down now, but we are looking pretty strong. So nothing more to say there. Cryptos, again, I think they're going to continue to underperform. Have I not been saying this for the last couple of months? I have, and they have been underperforming, especially after this this ETF-driven spike that brought us up to resistance in Bitcoin. And metals. Well, metals are still in ranging mode, and I'd love to get excited about them because we get a nice couple of green days, and then we get a red one, and then a couple of greens and red one. It's the same story. We're still ranging. If you want to play the levels in gold, I think 1985, 1930, let's say 1940. 1935 to 1940 on the downside, and then the big level is 1895. Those are the levels for me. I'm not touching them until one of those two gets broken. If the dollar spikes to 103.50, the Dixie spikes to 103.50, I think we'll likely break these lows here and head back towards 1900. Similar story in silver. It's always gold times 2 or times 3 sometimes. You could argue that we had an impulsive move higher here, then a kind of a correction. But again, we haven't broken any levels. 25.30 is the first level, and to the downside, those 24 lows. So until those get broken, I am not going to get excited about metals. I'm still running 2/3 of my position from 23.09 long, and I'm very comfortable with that. Yeah, so FX-wise, not much more to say. Norway, I'm looking at. Norway should have been a lot stronger, so these pairs should have been lower, but they're not yet. Even though the Bank of Norges Bank didn't increase the amount of selling that they do as expected, they kept it flat, and we got this good data today. But markets don't care, right?
About these data, by the way, thanks Simon for putting that up. Apparently, there has been a very, very low response to this survey in July, which is not unusual. I'm reading what Simon has put there. So it could be a distorted number. August may be different. Let's put it that way. So it's a very low sample of respondents.
Thanks for that. That's pretty much it from me. So a bit of the same as last time, but trying to keep you up to date with my views.
Yeah, thank you very much, mate. Very good. Kay, did you want to just grab a quick couple before we close up?
Yeah, if you like to, mate. Let's do.
Still handing it over.
Yeah, I'm. Let me just take the screen.
While you're doing that, I just want to answer RA talking about inflation picking up on the back of oil. It's not a simple equation that oil's gone up. Everyone's looking at the oil price going up and thinking, oh, yeah, it's going to be inflationary. Oil's been stuck in a range for the past 6 to 8 months, $20-30 range. It fell 27% between 13th of April and 4th of May, and now it's up 15%. So, you know, don't listen too much about the numbers. If we get a break higher in oil, then we might be talking about high inflation maybe 6 months down the line when the feed through, the pass through happens. But don't get too excited about the oil price rally in terms of inflation just yet. All yours, mate.
Okay. Oops, that's not the one. So we are comfortably back above the daily cloud in the dollar-yen. I always advise people to keep that in mind. Just look at it every day, where it is. So today, because the Japanese really look at that, and today it's around 141.60, the top of it. So that should be your major support over the day. And not far below, we are going to find this. Come on, hey, what are you doing to me? And not too far below, we are going to find this bit of a support line here as well. Yeah, it's all around there in the lower 141s. So that's going to be your first zone of interest. And then I'm having this this bit of a trend line, a bit of levels here, prior lows. This to me is going to be your gateway for 145, 143 and a quarter, 143.60. That's to me an interesting enough zone here to keep an eye on. We could go and test it and then have another look lower if in the meantime either the JGB yields are continuing to grind higher, or we are getting more comments or so, or something happening with the dollar. And since I said the option vols are coming lower now, the event is behind us. It should slow down the dollar-yen progression. But in essence, for as long as the radar keeps it so slow, I don't see too much of a reason to get long yen versus in between brackets high yielders, which the dollar is one of, or stuff like the mix or so. So I reckon on the flow side, it's still not not good to be long yen for longer. You need to be right very quickly, like in those kind of moves or those kind of moves. You need to be right quickly, because if you stay long yen for several days or weeks, the funding is definitely going to bite. Euro dollar, I reckon it's going to be a slow grind, because the ECB and the Fed are really working together, as Dale also said, and as we have been saying on this show for a long time. We are trying to break this smaller trend line here, but it's a rising one, so we could go like sideways as well. To confirm that this euro dollar is going lower, I think we need to break 109.45, okay? If over the ISM or so we break 109.45, but then again we have more important data during the course of the week, but through 109.45 we may see this acceleration down to 108.80 or so. That wouldn't be even too much of an ask, because it has been a traffic zone in the past. So before the next set of data, if ISM surprises to the top side, we could see a test down to 108.80, I'd say. We did give it a go yesterday over the couple of us over the end of the month fixings. So that's going well, managed already a bit, and now the risk is very much contained. But if this would go today over 110.5 because of weakening data, then I think we're back in for a test up to the 111.5, so, or even 112. So I think flexibility, and also what I said in the room this morning is I think that we might see the euro dollar stabilize and crosses perhaps move more around it, because there's some kind of like yeah, as I said, the ECB and the Fed are trying to work together, even if the wording is different. But I think the process may be interesting, and we are in entering this interesting zone on the euro sterling, right? Into those low 85s, 85, 85.40. If we'd ever get that, it's going to be an interesting watch. And I know Ryan has been banging on about this level as well. It's prior highs too. So this is going to be interesting. The rest I probably, yeah, just one more. Dollar China is trying, but we are again in this zone. The good thing is that we've broken a small intra-range resistance line here around 715.5, 16. So that should act now as a bit of support, but we really will have to break above this zone, which we have tried already several times, 718, call it, to go and have a test of 720, 720.5. If that would break, then I think there's more to come, okay? But for as long as we are here, we can only, even if everything points to a weaker yuan right now, it's still the price action which is going to dictate what we are going to have to do with this, okay? I'm small long, but I've now really ramped up my stop to below this this trend line. If it fails again, I don't think I'm going to like it. And I'm looking at the clock. This is good enough for me today, I think, Ryan.
Yeah, thank you very much, mate. Thank you for your input and Stel's input. And as always, you guys and girls in the comments, giving us something to talk about. Ali, yeah, we've talked about inflation. Yeah, it is a race between, or a fight between the different countries over who comes out on top. Brian asked about the zones in the chat room. Pretty simple answer, but we can go over that. Thank you, everybody, for coming to the Flow Show. Enjoy the rest of your day. Watch that data again today. Don't get too locked in to a bias, Mike, when we have big data that can move the price around. So get your sniper rifles out. Thank you all for coming to the Flow Show. We will see you all tomorrow. Cheers.
Thank you, Ryan. Thank you, Kay. Everybody, take care.